Imagine waking up tomorrow and discovering that the most expensive, most exclusive neighborhood in all of Las Vegas, the one place everyone swore could never crash, has quietly turned into a ghost town of for sale signs and desperate sellers slashing prices by hundreds of thousands of dollars just to escape. I'm talking about Summerlin, the 22,500-acre crown jewel on the west side of the valley where casino moguls, surgeons, and California refugees built their forever homes, the master plan paradise that was supposed to be completely immune to real estate cycles. Well, smash that subscribe button right now because what I'm about to show you with cold hard data will absolutely blow your mind and might just save you from making the biggest financial mistake of your life. The Summerlin market hasn't just cooled off, it hasn't just slowed down, it is in full-blown free fall and almost nobody in Vegas wants to admit it out loud, so drop a comment below and tell me if you've noticed the same thing driving around the Ridgers, Red Rock Country Club, or Summerlin South lately because the numbers are brutal and getting worse by the week. Right now, there are nearly 900 homes sitting unsold across the entire community. That's a 25% jump in inventory in a single year. And here's the part that should make every owner in Summerlin lose sleep tonight. 70% of the homes that do manage to sell are closing below asking price, many of them 10, 15, even 20% under list. And we're not talking about fixer-uppers on the edge of town. We're talking about multi-million-dollar custom houses behind guarded gates that used to have waiting lists and buyers camping out overnight for new lot releases. 2 years ago, builders were moving 1,500 new homes a year in this zip code alone. Last year, that number collapsed to just 782. That's a 50% drop in sales volume while inventory keeps exploding higher. And if you think that sounds bad, wait until you hear how long these palaces are actually lingering on the market now. 65 days on average, with plenty rotting for 4, 5, even 6 months while the sellers panic and drop the price every couple weeks, just praying somebody bites. Luxury properties over $1 million, over 100 of them are active right now, and last month only 10. Yes, 10 managed to close. That is not a slowdown, folks. That is a collapse in slow motion. Hit that like button if you're shocked already because I'm just getting warmed up. New construction, the engine that was supposed to keep Summerlin growing forever, has slammed into a brick wall. Permits are down 33% year over year. The giant national builders like Lennar and D.R. Horton, who were printing money here for a decade, are quietly canceling phases, walking away from land they paid top dollar for, and the ones still swinging are throwing Hail Mary incentives at buyers, rate buydowns to the threes, free pools, 6-figure upgrade packages, paying all closing costs, anything to move dirt because they know if they don't sell these spec homes fast, the banks are coming for them. Even Sun City Summerlin, the massive 55-plus enclave that used to flip houses the same week they listed, now has 93 active listings, taking 47 days on market and climbing. Retirees who need liquidity yesterday are getting absolutely hammered because they can't wait for a recovery that isn't showing up. Drive through the Ridges or Ascaya right now and try to count the for sale signs without getting depressed. $1 million price cuts are becoming normal. $200,000 off here, $300,000 off there, and still no takers because the buyers who drove the pandemic insanity, those California tech workers who fled here with fat RSUs, paying cash, waiving appraisals, and bidding 50% over ask, have completely vanished. Remote work policies changed, their stock portfolios got crushed, and a lot of them never really wanted to live in the desert in the first place, so now they're stuck holding houses they overpaid for by insane amounts. And the scariest part is many of the peak 2021-2022 buyers who came in with FHA 3.5% down loans are already underwater, owing more than the home is worth while they bleed $400 or $500 a month just on HOA fees alone, plus property taxes, plus keeping a 6,000 square foot mansion from falling apart in 115-degree heat. Builders are making the problem worse instead of better because they're sitting on thousands of finished lots they bought at the absolute top. They can't profitably build at today's prices, but they can't stop building either because of loan covenants. So they're dumping brand new inventory at fire sale levels that undercut every resale in the neighborhood and trigger a vicious race to the bottom that is crushing longtime owners who thought they were safe. The psychological shift is complete. Buyers now hold all the cards. They lowball shamelessly, demand every repair, and walk away over the tiniest issue because they know another desperate seller is right behind this one. The rental market that was supposed to catch falling knives is completely saturated. Investor properties that were projected to cash flow $2,000 a month are lucky to pull $2,500 now, after giving away 2 or 3 months free rent just to get a tenant in the door. Even the Howard Hughes Corporation, the master developer that spent 30 years curating Summerlin's luxury image. Howard Hughes has gone into full damage control mode, publicly lowering guidance and admitting sales are going to be ugly for the foreseeable future. When the company that literally invented the community starts talking about returning momentum instead of bragging about record profits, you know the party is over. And here's the kicker nobody wants to say out loud. Some of today's metrics are actually worse than the 2008 crash because back then interest rates were falling and rescue was coming. Today, rates are still elevated, affordability is shot, and a $640,000 median home now carries a $4,500 principal and interest payment before you even add taxes, insurance, and HOA, pushing the real payment closer to $55,000 or $6,000 a month. The pool of qualified buyers has shrunk to almost nothing, and it's getting smaller every time the Fed speaks. Builders are now openly pivoting to affordable product inside Summerlin, smaller lots, attached homes, stripped-down finishes, because the million-dollar detached luxury buyer has disappeared. The brand that was built on exclusivity is being diluted in real time just to keep dirt moving. People are already voting with their feet, heading 5 miles east to Spring Valley or Rhodes Ranch, where they can buy nearly the same house for $200,000 or $300,000 less. Why pay a premium for a zip code when the premium no longer exists? Country clubs are hurting. High-end restaurants inside the community sit half-empty. Retail centers have dark storefronts. Even the championship golf courses are dealing with water restrictions and declining memberships. Population growth, the fuel that justified these prices for 2 decades, has flatlined as Californians reverse migrate or head to even cheaper states, leaving nobody to absorb the tsunami of inventory except locals who make $60,000 a year and can't even afford a 2-car garage in Summerlin West. The trajectory is crystal clear and it is ugly. Inventory keeps climbing, sales keep collapsing, days on market keep stretching, price cuts keep accelerating, and the corrections required to bring this market back to reality are not 5 or 10%. We're talking 25, 30, maybe 40% haircuts from the 2022 peak before enough buyers feel comfortable stepping in again. That means virtually everyone who bought in the last 4 years is going to end up upside down. Short sales and foreclosures are inevitable once the forbearance and denial phases wear off. In the 30 years, Summerlin's success story could be permanently scarred in less than 2 years. If you own there and you're watching this, the math is brutally simple. The people who sell now, even at a painful loss, are going to look like geniuses compared to the ones who tried to wait it out. Because there is no cavalry coming, no new wave of cash-rich buyers on the horizon, just more inventory, higher rates, and a whole lot of regret. Summerlin isn't just struggling, it is in the early stages of a historic unwind. And if the most prestigious address in Las Vegas can fall this hard, this fast, what does that tell you about everywhere else in the valley? Smash the subscribe button and turn on notifications because I'll be tracking this story week by week with fresh data drops nobody else is talking about. Drop your thoughts in the comments. Are you seeing the same thing on the ground? And I'll see you in the next one.